Hello everyone, I am Mohit Ahmed Siddiqui with another video of SIMA P1 paper, Management Accounting paper. Now in this video, I will explain planning and operational variances. The first thing that you need to understand about planning and operational variance is that you need to know the very key point, in fact, the most important point that you need to know about planning and operational variances is that for planning variances, we compare uh, the revised standard. For planning variances, we compare the revised standards against what we budgeted, and for operational variances we compare the revised against the actual. So here I have a question from the Kaplan study text. This is an example of Kaplan study text, and in this example we are required to calculate the planning and operational variances. Okay, so here what is happening actually, before moving on with the video, I will suggest that you pause this video for a moment and you just read the question once. It will make things easier for you to understand. Okay, then now in this question, what uh, what is happening actually, we are required to calculate planning and operational variances. Why? Because there is a change. There is a change in the labor efficiency. The question says that the budget resulted in a 25% increase in standard labor efficiency, such that it is now possible to assess 5 applications instead of 4 applications using 8 hours of labor. This means that the labor efficiency has improved. Labor efficiency is not the same as we budgeted. Over the time, I think it has improved. And now 5 applications can be processed instead of 4 in the same time. So in the same time, when we were able to in the same time that we were able to process 4 applications, now we can process 5 applications. This means that the budget should change. The budget should change as the conditions have changed. So let me show you. The budgeted number of applications are 500. The budgeted number of applications are 500. But now we can process 5 applications instead of 4 in the same time. This means that we need to, we need to change this budget, we need to change this figure to the revised conditions. So before uh, before the change, before the improvement in the labor efficiency, we were able to process 4 applications, but now we are able to process 5 applications. That's why I am multiplying this figure. I am multiplying 500 by 5 and we are dividing this by 4. It will become 625. This means that previously, we were able to process 500 applications in 1000 labor hours, but now we are able to process 625 applications in the same time, 1000 hours. And the cost will remain the same because the number of hours will not change. The total number of hours, the total number of planned hours will not change, has not changed. But instead, we are able to process more applications in the same amount of time. So we are not supposed to change the number of hours. The cost will also remain the same since the number of hours are same. The cost will also remain the same for the revised standards. Now, cost per application. For cost per application, what we will do, we will take the total cost, we will divide it by the number of applications to get a cost per application, that is 8. Now, time per application, how will we calculate? We will take the number of hours and we will divide it by the number of applications. Now, cost per hour, we will take this cost, we will divide it by the number of hours. It will be $5 per hour. So these are the revised standards. This is I think this is I think revised standards. Revised standards are something that sit in between budgeted and the actual. That's why I have taken the central column, I have taken the middle column of the three columns for the revised standards. For now I am again repeating the same point that I told you earlier in this video when I started. For planning variance, we need to compare budget with the revised, and for operational we need to compare revised with the actual. So let me calculate planning variance in front of you. Now, planning variance, the cost per application has changed. As I told you that what happens that we for planning variance we compare budget against revised. So the cost per application has reduced according to the revised standards. The planning variance will be 10 minus 8 multiply by the number of actual hours. The number of actual hours. So this is the planning variance. The answer that we will get is 1100 favorable. Favorable, why it is favorable? Because the cost has reduced. Originally we anticipated that the cost will be $10 per hour according to the original budget, but the cost has reduced to $8 per hour instead of 10. This is a profit, so this is something favorable. So planning variance is 1100 favorable in this way, and we multiplied it by the actual number of applications. This is the cost per application 10. 8 is the cost per application for the revised standards. We multiply it by the actual results. We multiply it by the actual results because when we get to calculate the variances, we see how the change affected the the actual results. So actually we processed 550 applications. Actually we processed 550 applications. We thought that each application would cost $10, but instead it cost $8. So the planning variance 10 minus 8 multiplied by 550 is 1100 favorable. So this is how we calculate the planning variances. And it actually involves comparing budgeted standards with the revised standards. Now, for operational variances, I for operational variances, I told you that we need to compare revised against actual. We need to compare revised against actual. So how will we calculate now? Here we need to calculate operational. Actually, we need to calculate operational labor efficiency variance. Labor efficiency variance. So you can say that the the operational variance, we need to compare in labor efficiency variance we actually compare the number of labor hours that should have been taken according to the standard and the labor hours that were actually used. So according to the revised standard, the actual number of hours that should have been taken are like 550 applications should have taken 550 multiplied by 1.6 hours. So according to the revised standard, you can say that 550 applications that we processed, the 550 applications that we processed should have taken 550 multiply by 1.6, 880 hours according to the revised standards. According to these standards, 550 applications should have taken 550 multiply by 1.6 hours. 550 multiply by 1.6 hours. And but actually the revised uh, but actually the number of hours, labor hours taken are how much? Are 1200. Now just simply take these figures and take the difference between the two and multiply it by the standard rate, that is 5 hours according to the standard set by us. As you can see in the cost per hour, as you can see here, the cost per hour is how much? The cost per hour is, just wait a minute. Yes. So the variance that we are getting, the operational efficiency variance, in fact, the operational efficiency variance that we are getting is how much? Is 1600 adverse. The operational efficiency, this is in fact the operational efficiency variance. This is in fact the operational efficiency variance. The operational efficiency variance is $1600 adverse, and the planning variance, is how much? Is 1100 favorable in this way. uh, Let me repeat once again the operational variance. In operational variance, what we did, we actually compared the labor hours, we actually compared the revised standard against the actual results. Now according to the revised standards, each application should have taken 1.6 hours. So what we did, we simply took multiple of 550 applications and multiplied it by 1.6, and then we took the difference between the two. We subtracted 1200 from it, and we multiplied it by the standard labor cost according to the original standard, that is uh, $5 per hour, to arrive at to get the operational labor efficiency variance, that is 1600. Now in the same way, you can calculate the operational labor rate variance. In the same way, you can calculate the operational labor rate variance. That should be something quite easy for you. Now the revised rate, how much is the revised rate? The revised rate is $5, but the actual rate is $4.25. The actual rate is how much? The actual rate is, yes, the actual rate is how much? The actual rate is $4.25. You can see the difference between the two in the last row. You can see the difference between the two. The actual rate per hour, cost per hour for the actual cost per hour is 4.25, is 4.25. But the according to the revised standard, the cost should be $5 per hour. Now we will multiply it by how much? We will multiply it by the number of hours. How much are the actual number of hours? 1200. 1200 are our actual number of hours. So now 900 is the favorable variance. 900 is the favorable operational rate variance. The total variance, how much is the total variance? the total variance should be the sum of these three, the sum of these three. So the total variance that we are getting is 400 favorable. And how did we arrive at this? 1100 favorable minus 1600 adverse plus 900 favorable. So this is, as you can see, this is how we calculate, how we determine the planning and the operational variances. I think you I think you got an understanding of planning and operational variances from this video. Please let me know if you need any kind of assistance. My name is Muhid Ahmed Siddiqui, and I normally post videos like this to help management accounting students and students of other exams as well. Thank you very much. Thanks for watching. It was Muhid Ahmed Siddiqui. Let me know if you need any assistance, and you can contact me via social media platforms like WhatsApp. My WhatsApp number is given here. You may also contact me via Facebook or any other social media platform that I am using, but frequently, normally, I use Facebook and WhatsApp. So please let me know if you need assistance. Hope to see you soon. Thank you very much.